Well, good evening. I take it we're good to go, Dan.
Yes, Chair, we're all good to go.
Right, thank you. In that case, hello, welcome to this meeting of the Treasury Management and Investment Subcommittee. I'm Chris Davidson. I'm a councillor for Patching Hall Ward and the Cabinet Member for a Fair at Chelmsford, and I chair this subcommittee. I'd like to remind everyone that this meeting is being streamed live on our website and is also being recorded. Remote meetings are new to the Council this year. They don't always go as smoothly as meetings held in person, so I hope everyone taking part or observing with us, particularly if we have any technical hiccups. To help us, councillors have been given guidance on the conduct of remote meetings. And the key points are, firstly, members of the subcommittee should be taking part from a place where they will not be disturbed or distracted. And secondly, when not actively participating, everyone should keep their audio and video turned off, please. Thirdly, if you wish to speak, please type an H in the chat box. I'll call you in the appropriate order. And you should then turn on your video and audio. And please remember to turn off again once you've finished speaking. All questions and contributions must come through the chair. Any councillor with an interest in any item should declare it and keep their audio and video off when considered, and they will not be included in any vote on the subject. And final point, when it comes to a decision on any of the matters before us this evening, if no one says they're opposed, I will assume that everyone is in agreement. If anyone does say that they're opposed, I will ask for a formal vote to be taken. Finally, just to be clear that if we lose the live stream on the website, I will adjourn the meeting for 10 minutes and hopefully the problem can be fixed. If it can't, I will adjourn the meeting until a future date. So the first item, just bear with me whilst I get the right papers in front of me. The first item is apologies for absence and substitutions. Dan, do we have any?
Thanks, Chair. No, we haven't got any. I'll just run through who we have attending. You're obviously here as Chair. That's Councillor Chris Davidson. We also have Councillors Bracken, Dan Clark, Paul Clark, Galley, Sozin and Whitehead. And the officers present, I'm here from Democratic Services. Mandy Fay is from Finance and so is Phil Reeves. Thank you.
Thanks, Dan. So item 2 on the agenda is the minutes of the meeting held on the 22nd of June. Are there any matters arising, any concerns anybody has, or are you happy for me to sign those? Applying the rule I've just indicated, there's no dissent to that, so I will be happy to sign those off. So the third item is declarations of interests. All members are reminded that they must declare any interests they know they have in items of business on the agenda, and that they must do so at this point or as soon as they become aware of it. If the interest is a disclosable pecuniary interest, they're also obliged to notify the monitoring officer. Are there any declarations of interest? No? Okay. So we then move on to public question time. Dan, do we have any members of the public present?
Any questions? On no public are present. Thank you.
Right. So hopefully there may be some members of the public participating via the live stream, but there's nobody participating in the meeting. No questions. So in that case, I'll move on to item 5 on the agenda, which is the Treasury Management Mid-Year Review. And Phil Reeves, do you want to introduce yourself and speak to that paper?
Yeah, hello, Chair. Thank you. I'm Phil Reeves. I'm the Accountancy Manager at Chelmsford City Council. This is an annual report that we make every year at this time, a review of Treasury management activity to date and a review of the strategy. It's a requirement by law. And the recommendation of the report reflects that it has to go on to Cabinet and then on to full council. The recommendation at the moment suggests no changes to strategy. This is something obviously the committee should consider and make sure that they're satisfied with. I don't intend to go through the full report, but if I could point out on page 11 of the agenda, if I can get there, there is an executive summary under paragraph 2. And I'll just quickly run that and give some background to it. And then obviously if members wish to give me any questions, and that's what we'll do. Executive summary, there were no breaches of the Treasury strategy during the year. So in other words, all transactions were compliant with the rules that had been set out by Council. Interest rates have fallen dramatically during the year. They're historically low yet again. Examples would be, at the moment, loans to local authorities, which we traditionally make for a year, would be about 0.3%. A loan for 1 month to another local authority would be 0.02%. So the interest rates are incredibly low and often don't necessarily cover the transaction costs of sending the money. Now, the next point in here is that the council effectively has borrowed to fund its capital programme, but that borrowing has been internal. We borrowed other cash balances and we haven't had to externalise any debt so far. Because of the nature of the cash flow this year, because of COVID, etc., there is some risk that we may have to externalise some debt or do some temporary borrowing, but that hasn't happened yet. The next point I focus on is that normally we have a range of investments. We have some slightly longer ones out a year or maybe longer, some 6 months, some 3. The way that we've set up the investments currently is it's very much aiming towards very short deposits with access or very short access. There's a couple of reasons for that. Firstly, the interest rates are so low, it's a marginal difference as to the period as how far you go out. Secondly, there's an interest rate, there's some counterparty risk. For instance, if we lend to some institutions, we incur additional risks. By keeping it short, you actually lower that level of risk. The money market funds themselves are attractive simply because they're short dated. The rates of interest are relatively competitive compared to other organisations. In fact, some short-dated investments that we'd make with the DMO, which is a government account we could deposit funds with, are paying negative rates. Treasury bills, which are very short government debt, are also negative as well. So we're actually having to pay other people to hold our money. At the moment, that's where we're focusing our efforts on short-dated money market funds. The other thing we've done is reviewed the situation regarding longer-term funds and using longer-term external managers to manage our funds on a longer-term basis. A good example of this is the CCLA Property Fund, where we've held that investment for a number of years. At this point, we're not recommending any new investments or any disposals. There is a section of the report, Appendix 1, which goes through the issues regarding the CCLA and whether it's worth continuing to hold or not. It recommends at the moment no change and that the investment should be kept there. Now, what that means is as well, in terms of the rest of the year, we'd recommend that the strategy remains unchanged. So we're not proposing to change any of the counterparty limits or remove fund managers from the list. So that's the conclusion of the executive summary. I don't know if members have got any questions.
I'll throw it open to anybody who wants to ask a question. Councillor Paul Clark.
Thank you. I guess we're just about to get to the point where you make the recommendation and we all agree. I had a look through this report on CCLA earlier. I see the valuation is down, the share valuation is down to 6.194. So the unrealised profit's fallen in 12 months from 1.7 to 1.2. The representatives from Arlene Close, who are the advisors, I understand, said that the redemption on this would be immediate if we chose to do that. But according to that report in 4.3, the report says it's 90 days notice. And during lockdown, this redemption wouldn't have applied because redemption was non-existent because the fund was suspended, which pretty much endorses the risks that this fund has. So in terms of recommendation, no, I'm not happy with it. I never have been. I've made that quite clear, and it's been minuted, and I'd like that minuted as well. The warnings weren't adhered to. We're now in a situation where you've got to decide whether you want to continue with a minimal yield, but the risks are still there if the property market doesn't recover. This isn't a situation that is exponentially growing. It's going in reverse. We are actually starting to lose money. And I guess the chart which compares the return with 3-month LIBOR was taken from the fund manager, because it makes no sense to compare a medium-term investment that's got a medium-term risk factor with 3-month interbank rolling returns, which have a very low risk factor and an immediate redemption. As I said, the fund was suspended from March 2020 to the end of September just gone. And during that time, you wouldn't have had access to any of that money anyway. And the mid-NAV has fallen by nearly 6% in a year and has fallen another 2.25% 6% since the suspension and 2.25% since February 19. If you wanted to compare anything with the same sort of risk, you would be looking at something like corporate bonds, which have a comparable yield, and coupons are over 6% for blue chip names. But we haven't made that comparison in this report, and I just wanted to know why we did that. Thank you.
Chair, did you wish me to?
I was about to say, Phil, do you want to respond to that?
Yeah. What we've done is we've compared it to what we would have done at the time when we took the CCLA out, which is we wouldn't have done corporate bonds. We have taken advice from Ireland Close, and they're not recommending that we undertake any new external funds at the moment. So that's why the comparison hasn't been made. It comes back to, we can exit the CCLA. At the moment, officers are recommending that we don't, based on advice from Ireland Close, obviously, who are saying that this is a good balancing fund. We do have the option of undertaking other additional funds, which we're not effectively recommending at this point because of volatility. It comes back to, we can choose to remove all funds off the list, but at the moment, the advice from Ireland Close is we should stick with this fund and take what is a good yield and has been a good performance to date. As the report notes, that there are significant risks going forward, just as there would be if we took the money out. We could end up paying negative interest rates on the fund sitting somewhere else, and we wouldn't have the income coming in either. So it is a balance of risks that members must recognise. But as I say, the recommendation at the moment reflects the advice we're receiving.
Does anybody else want to comment? Councillor Bracken, you look as though you're poised to put your H in the box. Over to you.
Thank you, Chair. Just to say that Councillor Clark, as we all know, has been opposed to this fund, I think, right from the very beginning before we even went into it. So he's being very consistent in his opposition to it. But it has been a very successful investment on behalf of the council. And if we look at the fund and what it is actually earning us still on the income front, without it, our income as far as our investments would be very dire indeed. I mean, they're not good, as you already said, because we're talking about negative interest rates if we're staying in short term. So I think to come out of this fund now would be a mistake at this point in time. I accept that the fund was closed for a while, and I accept that we can redeem it if we wish to redeem it. And if we did redeem it now, we would still be taking a large capital gain. But we have to ask, what will we do with that capital gain? We would have to invest that possibly in short term and possibly in negative interest rates. So I don't think we should be thinking to come out of it at the moment.
Thank you. That coincides with my view as well. our strategy all along has been to invest in a fund that gave a very good income return and gave the prospect of capital growth as well. But we recognised that it was at least a medium-term investment. It wasn't something that that we would wish to invest in for the short term. I think, Phil, it's also true to say that it's not the sort of investment where you can dip in and dip out. The bid offer spread is such that you either get into it, stay in it, or you get out and stay out. There's no, you can't do the hokey cokey with this. You can't be in, out, and then in, out again.
That's right. There'll be a 5% charge. The other thing, of course, is it's always a question of whether you can actually call when it's the best time to get in and out as well. And that's one of the things by going for the medium term you hold and you try to ride out the volatility. You should only come out of the fund if you think that there is a long-term risk that you are not going to get your funds back. And as we've seen from some of the graphs in the table, over the time, the income yield has been incredibly good and has generated more than the capital in terms of return. So again, we should always bear in mind this point about the income return in the long run.
So I guess there's two questions, and if you could just confirm these. One is that our strategy has been and continues to be that we stay in this and ride out the current volatility, even if the capital value continued to go down somewhat. As long as that's offset by the income return, we'd be better off than investing it somewhere else at a negative return. But you'd hope, I assume, that we'd get some capital recovery as well as a continuation of income. And the second question, and presumably we are expecting to be able to hold this money for a period and not reach a point where we desperately need to raise £6 million and we have to go to this fund and find ourselves in a fire sale scenario. This is something that we have planned and can afford to leave there.
In terms of the last question, yes, we can afford to leave it there, particularly while it's returning more than it would in short-term debt. So at the moment, the yield is over what we'd have to borrow at, even if we did have to borrow temporarily for cash. In terms of riding out the volatility, a good case would be is something I've just received today, which is why it's not in the report, is that the fund managers have said that they expect an uptick in value in the third quarter because income has been good and they've reported quite good levels of income recovery from the tenants. However, what they've then gone on to say, obviously, is because of COVID, there may be a downtick in the last quarter of the year. So it will be a bumpy ride, and it simply won't just spring back in a few months. It may take a year or two to recover to the levels we've seen. And there is always a risk that it doesn't. And that's fundamentally the thing when you do these long-term investments, is you just have to accept there is risk and volatility involved. And yes, we can afford to hold it. And the advice is that we should continue to see this as a volatile position, but one that will hold its value in the long run.
Thank you. Councillor Whitehead.
Oh, yeah, I'm just saying I will endorse your current strategy. If it were all our money, it wouldn't all be there. As it's a part of our total pot and it's a medium-term investment, it does seem logical that we do ride out the storm. I'm trying to do the same in my own share portfolio, really, but no more successfully than anybody else, I think. But one that I understand Councillor Clark, I know what he said in the past, and if we weren't into an era of negative interest rates and we could take it out of there and put it into something earning 3 or 4%, then I'd probably agree with him. But to take money out and earn less on it than we're earning now, and in fact a negative amount, seems to me probably the wrong policy. So I'd like to endorse the strategy.
And I think it's probably fair to say that the investment in the first place was under your administration. And we have continued with that strategy because we've seen the logic of it.
Yes, I mean, it was, and Councillor Galley's on the line here, I'm sure, really. I won't say it wasn't me, but it certainly was our policy at that time. Interest rates were somewhat different, of course, and things have got to a stage which none of us predicted. But I think on the basis of it is not all of our money at once in one place, then we should continue as we are.
So thank you for that. Does anybody else wish to speak, or should we just proceed to a vote on the recommendation? I don't see any more hands raised. So I suggest we proceed to a vote, and Councillor Clark has asked for it to be a formal vote. So Dan, do you want to take us through that? Do I need to formally put the motion? Cabinet note the contents of the report and request that full council approve that no changes to the 2021 Treasury strategy are required.
Okay, right, I'll just run through each member and ask for if you're in support of that motion. So first, Councillor Bracken.
Agreed.
Thank you. Councillor Dan Clark.
Agreed.
Thank you. Councillor Paul Clark.
I'm against that.
Thank you. Councillor Galley.
Agreed.
Thank you. Councillor Sozin.
Agreed.
Thank you. Councillor Whitehead.
Agreed.
And Councillor Davidson.
Agreed.
Okay, thank you. So that motion is passed.
Okay, thank you. So I think what I now have to do is to move under section 100A(4) of the Local Government Act 1972 that the public, including the press, be excluded from the meeting during consideration of agenda item 7. This is on the grounds that it involves the likely disclosure of exempt information specified in paragraph 3, part 1, schedule 12A of the Local Government Act 1972. Is that agreed?
Agreed.